Okay, so class 9 will have some overlap to last class. I want to reacquaint you, get you very familiar with this template that we will be using for the tactical asset allocation question. An extremely important question because it's the true application of everything we've learned up to this point. The DC cuts I, the bucks for stocks. So everything we've learned, we're going to now apply it. And so that's why it's so critically important that if you can get this allocation, tactical allocation down, then you are essentially understanding everything we've talked about before. So let's look at the template. So I will give you a scenario, a forecast, and based on that forecast, it will be about the economy, about interest rates, about the volatility of interest rates, something about inflation, maybe some specific things going on with different currencies, something going on with different types of commodities, and so maybe some insights that give you some very obvious hints what you would do, some other ideas that are more general, but would definitely, maybe not it's 100% you would do this, but most of the time certain scenarios lead to certain overweights and underweights to most people in finance. There are places you can argue the other side. If you do that, you just have to fully document and make sure it's rational what you're saying. So the goal here is not that there is exactly one answer, although I word the question so that it's pretty obvious what the most conventional recommendation would be. So if you want to go unconventional, you have to make sure you really document that even more. That's the advantage of going the conventional approach, is you don't have to provide so much justification. So I'll give you that, and then you have to decide what to overweight. Remember, overweight means you really like that asset class, so you want to do more with that. And then underweight means you don't like it. You want to pull back, not necessarily to zero, but if you're normally 10%, maybe you would cut back to 5%. In this particular template, I'm not asking you to actually tell me how much to overweight or underweight. So you have that advantage. You can just say underweight, overweight. You don't have to say underweight significantly or underweight slightly. And you can put those words in if you like, but that's not what I'm asking in this case. I just want to make sure you're comfortable with the direction. Does this scenario argue in favor of this asset class, or does it argue against it? And then when I give you that scenario, I will then give you a list of asset classes. So I won't let you just make up your own asset classes. I'll give you a very definitive list, and we'll practice it. You'll see some examples here where it'd be exactly like what we'll be doing on the exam. So, so what needs to be part of your rationale? Well, one thing I will not list in the asset classes is stocks versus bonds. That's just a given. So even though I don't list, I'll be listing subcategories of bonds and subcategories of stocks, but I won't just say stocks and bonds. You have to know that in any asset allocation, that's usually where you start. And that is going to be tied to the strength of the economy. So it should be obvious to you by now, and probably even before you took this class, if you're expecting a strong economy, then you want to be allocated more to stocks. If you're expecting a weak economy, you want to be allocated more to bonds, especially high quality bonds. So start with that. Strong economy, you want stocks and riskier assets. Weak economy, you want bonds, especially high quality bonds. So make sure that's always in your answer somewhere. And then when you get to bonds, remember DC cuts I. So for the DC cuts I, we'll use all of those on the bond side except for structure and US versus non-US. So the U and S of DC cuts I don't know what that spells, but DC, CT, I without the U and the S. So those will not be on the exam. We will talk about not US versus non-US on the stock side. So you have DCCTS. So you know duration, you need to talk about the direction of interest rates. So here, make sure it's in your notes and you're real comfortable if it. So remember there's a connection here between credit risk and the direction of interest rates. If you expect a strong economy, you will generally expect interest rates to rise. So a strong economy, you want to go to stocks. Within bonds, you want to buy lower quality bonds. And within bonds, you want to shorten duration. So a strong economy, more stocks, lower quality bonds, and shorten duration because you think interest rates will rise. All right, so that's really, really important. Duration and that tied to credit risk. Convexity really just there has to do with, do you want positive convexity bonds or negative convexity bonds? So make sure you have it clear in your notes. If you expect interest rates to be more volatile, you want positive convexity. Things like longer-term treasuries, longer-term corporates that are not callable. If you're expecting interest rates to become less volatile, so they're volatile today, but they're going to settle down, that's when you want negative convexity bonds, especially, I relate this to mortgage-backed securities. So remember, mortgage-backed securities are very high quality, but they pay a spread over treasuries, not because of credit risk, but because of their negative convexity. And so negative convexity, because you have a negative convexity, you get a higher starting yield, a starting spread, that if interest rates become less volatile, you get to capture that extra spread. So it's not related to credit risk, but it's related to volatility of interest rates. On taxes, there you just do the math. So you're usually selecting between municipal bonds that are tax-free and corporate bonds. Remember, you do the tax equivalent yield. But remember, with corporates and municipals, you also have duration and quality. So if I give you high quality municipals that are short term or long term, you have to bring that into the equation. Now, when I do the math, do the exam question, I make my municipals and my corporates the exact same on duration and the exact same on credit quality. And so, but you need to still talk about it. So if I give you low quality municipals with high duration and the economy is going to be strong, then you need to say, I like municipals and corporates both. They're both short duration, they're both low quality. So if the economy takes off, I like the low quality because you're going to get more of that spread. You get paid for taking that risk. I like the short duration because with a strong economy, interest rates will rise, and I want the short duration. But then I have to choose between municipals and corporates. So your answer needs to have all three of those things. Why do you want the municipals and corporates? Because of quality. Why do you want them? Because of the direction of interest rates related to the duration. And then once you decide on those two, then you have to decide on between municipals and corporates related to the tax equivalent yield. For inflation, it's just, do you want to overweight or underweight tips depending on whether or not you're worried about inflation? Very simple one. Then you get the stocks, capitalization, style. Those three are all related to the strength of the economy. So remember in your answer, extremely important, that let's say you expect a weak economy. So a weak economy, you want to say, I want to underweight stocks, overweight high quality bonds. However, within stocks, so that's a really important phrase, within stocks, I want to overweight low beta stocks. I want to overweight large capitalization stocks. I want overweight growth. Remember, low beta, those are defensive stocks. High capitalization, large cap stocks, and growth do better in weak economies. High beta stocks are cyclical stocks. Small cap stocks and value stocks do better in strong economies. So just make sure you have that. All right, let me say it again so you can write it down in your notes. Low beta, high capitalization, and growth do better in weak economies. Low beta, smaller, lower capitalization stocks, and value stocks do better in strong economies. All right, so all three of those are tied to the strength of the economy, but you have to talk about all three of them. So if I give you high beta large cap stocks or cyclical large cap stocks, there's two things there. They're large cap. So if you have a weak economy, you say, yes, I like large cap over small cap because of the weak economy. And if they're low beta, then you say, I also like them because of low beta, which will also do well in a weak economy. You have to talk about both of them. If you don't, if you just say, I want to overweight large cap, low beta stocks because they do better in a weak economy, I only give you half credit. So make sure you have 2 points. If I have large cap cyclical stocks or large cap, low beta stocks or defensive stocks, make sure you know you have two things to talk about there. If I have small cap, high beta stocks, make sure you know you have two things to talk about there. If I have small cap growth stocks or small cap value stocks, so small cap value, those will both do well in a strong economy. So if I give you small cap value stocks, say I really like small cap value, one, because small cap will do better in a strong economy, and value stocks will do better in a strong economy. So I hope you're understanding this, that you have to be real explicit in your answer. Then U.S. versus non-U.S. On that one, I have to essentially just tell you. So if I expect European markets, economies, if I expect European economies to do better than the U.S. economy, then I'm going to want non-U.S. stocks, especially developed market stocks, over the U.S. If I say the U.S. economy would do better than Europe and Asia, then I will want U.S. stocks over non-U.S. stocks, especially developed market stocks. The other thing I will talk about are currencies. If I expect the U.S. dollar to be strong, then I'd rather have U.S. stocks over non-U.S. stocks. And I make that on the exam so they're consistent. I don't make it so that non-U.S. developed market stocks should do well, but their currencies will do poorly. I set up my answer so that those two are consistent. There are times in markets where you expect non-U.S. market economies to do well, but their currencies to do poorly. I'm not going to give you that scenario. In those scenarios, you would have to figure out which is going to dominate. Is the currency going to dominate, or the economy is going to dominate? Then with the emerging market stocks, there it just comes down to, I'll just have to blatantly tell you whether I think emerging markets will do well or do poorly. And then alternatives, you're looking for clues about inflation. Remember, real assets do well, especially with high inflation. You're looking for concerns about being well diversified. Maybe there's a lot of uncertainty. And so remember, real assets and private equity give you good diversification. And then there may be specific issues raised about particular real assets. I might say steel and timber are expected to do prices that fall dramatically because of the weak housing market. In that case, you would want to say underweight alternatives, especially commodities tied to the housing market like timber and steel, because their prices are expected to fall. So sometimes I give you very straightforward, and some students completely forget or just don't talk about those at all. So if I talk about commodities, then see how that affects your overweight or underweight. So your answer will look something like this. You'll have one bullet talking about stocks versus bonds, and there you're talking about the strength of the economy. So it's a quality issue. Do you want low quality assets which have higher expected returns? Or do you want higher quality assets? They have lower expected returns, but they'll do really well when economies are weak or there's not much growth. So that's the quality argument. Under treasuries, there's two things to talk about treasuries. Duration. Do you want to be longer term or shorter term, depending on if rates are rising or falling in quality? So make sure in your answer, in fact, I would recommend strongly that you develop your answer exactly like this. You have stocks versus bonds. Remember, that one's not given. You just have to know to talk about them. I would talk about them first. You just have one bullet there. If it's a high quality economy, then you want to over-allocate stocks, under-allocate bonds. If it's a weak economy, over-allocate stocks, over-allocate bonds, especially high quality bonds, under-allocate stocks. Under treasuries, two bullets. You want to talk about the direction of interest rates and whether or not the economy is strong or weak. Weak economy, obviously you love treasuries. Weak economy, you want to go out on duration, because in weak economies, interest rates usually fall. Tips, there's only one thing to talk about there, and that's inflation. If your boss expects inflation, then tips might be a really good place to over-allocate. Mortgage-backed securities, the only thing to talk about there is convexity, and that's where you talk about the volatility of interest rates. If interest rates are expected to become more volatile, you want to underweight mortgage-backed securities. If they're expected to become less volatile, you want to overweight them. And make sure you say in your answer, let's say we expect interest rates to become less volatile, you want to overweight mortgage-backed securities because interest rates will be less volatile and you can capture that higher starting yield. That entire thing needs to be in your answer. And then municipal bonds, this is municipal bonds versus corporates. This is where people miss most of their points because there's 3 items, and a lot of students only talk about one of these. So make sure on municipals versus corporates you have 3 bullets. The first 2, you'll be consistent. If municipals are high quality and the corporates are high quality, and I always make them the same for the exam, so you'll either have high quality, medium quality, or low quality municipals and corporates. And the duration will be the same. They'll either be short-term, intermediate, or long-term. So you need to talk about duration. If rates are falling and the municipals and corporates are intermediate or long-term, then that would be good. If interest rates are rising, you'd rather have short-term. On quality, do I give you high-quality municipals, medium quality, or low-quality municipals and corporates? They'll be the same. If you're expecting a strong economy, then you go to the lower quality. That would be good. If you're expecting a weak economy, you'd rather have high quality municipals and corporates. So those 2, the answer are the same. And then the only way you distinguish whether have municipals or corporates. So let's say you said, I want to overweight municipals and corporates in this environment, but between the 2, I'd rather have a higher weight to municipal versus corporates because the tax-adjusted yield for corporates is higher. And remember that formula? You take the tax rate on the municipals and you divide it by 1 minus the marginal tax rate. You'll adjust that rate up so you can compare it 1-to-1 to corporate rates. Do not adjust the corporate rates. You don't do any math on the corporate rates. You only take the municipal yield and divide it by 1 minus the marginal tax rate. And that gives you a number you can compare. If that's higher than the corporate bond yield, then you would recommend municipals over corporates. When you get to high yield, there's only one sub discussion there, and that is quality. If you're expecting a strong economy, then high yield would be great. If you're expecting a weak economy, then you want to avoid high yield. Notice I don't say anything about duration. We talked about that in a previous class. With high yield, duration is not an issue. Most people don't talk about short-term high yield and long-term high yield. High yield, if the economy is strong, high yield will do well. Even if interest rates are rising, the quality side will more than offset anything related to duration. So you don't have to talk about duration at all. And I don't even tell you enough that you could. I don't tell you if they're short-term or long-term or intermediate-term high yield. I just tell you they're high yield. So there you finish the bonds. Now in stocks, you'll have at least 2 items. I'll give you large cap stocks, but I'll give you something probably related to quality, beta, and R style. Usually 2 of them. So I might have large cap high beta. I might have large cap growth. So, I mean, those are both related to quality, so sorry about that. So something either related to beta or style. You already have the large caps. So a strong economy, you prefer small cap over large cap. Strong economy, you prefer high beta over low beta. Strong economy, you prefer value over growth. And just the opposite in everything else. And that's large cap versus small cap. So we're not going to, this is where I say within stocks, this is so important. So if you expect a weak economy, you want to be underweight on stocks, but within stocks, you want to overweight large cap defensive growth stocks. If you're expecting a strong economy, you want to be overweight with stocks, and within stocks, you want to overweight small and mid cap stocks that have high betas and are value. If you're expecting a weak economy, go to large cap. Go to low beta, go to defensive, go to growth. All right, hopefully you have that in your notes and just say it over and over again. Not for the exam, who cares about the exam, but this is so you sound intelligent in an interview and you understand what we do in finance when it comes to asset allocation. And then developed markets, I'll tell you which markets are expected to do well, and so that's the quality. Which markets have stronger expected economies and which have weaker. So you want to over-allocate. If the U.S. economy is going to have the strongest growth, then over-allocate to the U.S. Otherwise, over-allocate to developed markets. And then look at the currency. And then emerging markets, that should just be really, I either tell you emerging markets are expected to do extremely well or extremely poorly relative to everything else. And you only have to say one thing, and that's just related to how they specifically are expected to do. Alternatives with real assets, you can talk about inflation. You can talk about the diversification. There may be some specific issues raised. I might say something about timber or something about steel or concrete. Private equity, it's a quality decision. Private equity will not do well in a weak economy. However, it does provide some diversification, similar to what we talked about with real estate, whereas there's a little bit of appraisal smoothing where you don't have the daily fluctuation of the market. So it does provide some diversification. So that is your answer. You want to have all of those bullets. Usually in a typical exam question on this part of the exam, there's about 18 things I'm looking at. And if you look at this, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, usually 2 under stocks, 12, 13, 14, 15, 16, and usually a couple under alternatives, 17, 18. There's 18 things. So what does that mean for your answer? You should have 18 sub-bullets, or somewhere in that neighborhood. It might be 17, it might be 19. I haven't written the exam yet, but you should have somewhere in that neighborhood. If you only have 10 bullets, chances are your best case is you'll get 50% credit. I used to say if I have 18 hot items, you have to get 16 of them to get 100%. But going forward, the last few semesters, enough students have done well that if I had 18 items, you had to get 18 items to get 100%. So some students get 10, 15, 20% on this because they only talk about 4 or 5 things. There's so much in the multiple choice mindset of, write a few things down and you'll be fine, just match a few things up, and that's not it. I want a complete answer. I'm not being picky, I'm being an advocate for your career, and you need to know finance at this granular level of detail. This is what finance people do, and these are the kind of questions you will get in an interview. You do have to know it at this level of detail, trust me. All right, so let's walk through some examples. This first example is a little shorter than a typical one, but it gives us a good way to start off. So if you look at this, your boss comes to you with a forecast, and she believes there will be surprises, economic surprises on the positive side. There's been recent good economic data, and she thinks it's genuine. Some people think this data it's going to turn around. We're hearing that a lot today, that some of the economic data in June, July looked better than it really was because the federal government was paying an extra $600 a month, and you have the stimulus, and all that was running out, and Congress is fighting over what they can do going forward. So some people say it wasn't genuine. She thinks it is genuine. Now this is a different market I wrote this in, so this is several years ago. You can see this is back 5, 6, 7 years ago. Who knows what was going on there? But she thinks it's legitimate. Not only that, she thinks it's going to surprise on the positive side. So already you want to move down in quality. She's expecting very good economic growth. She's expecting positive economic data. That means you want to buy stocks. You want to buy high yield. You want to buy small cap stocks. You want to buy high beta cyclical stocks. You want to buy value stocks. You see how that works. So just in that one paragraph, you already have a lot of information. So you probably don't want treasuries. You probably rather have corporates and municipals and high yield. You don't want treasuries in this market because everything's going to be positive. With a positive environment, she actually tells you here that if I don't tell you on the exam, if I give you strong economic growth, the most logical assumption is that interest rates are rising. But she actually tells you here. She thinks inflation is going to remain contained. Now, I don't have that highlighted because TIPS was not one of the assets I gave on this exam. But if I had given TIPS as an asset, you would not want to have TIPS in your portfolio because inflation is not going to be an issue. But interest rates will rise. So you want a shortened duration. If interest rates are going to rise, you want a shortened duration. So you definitely do not want long-term treasuries in this market. You don't want treasuries because they're too high quality and the economy is going to do well, so you can get a lot better expected return elsewhere. You also don't want long-term treasuries because interest rates are rising. She says emerging countries should see very strong growth. All right, so right there you have it. Let's overweight emerging market countries. They're going to do well. But developed countries, especially Europe, should see very weak growth. All right, so right there, We prefer emerging markets over the U.S., but we prefer the U.S. over developed markets. Remember, on the exam, we have developed markets and emerging markets. I don't usually put frontier markets on the exam. So here, definitely your order of importance is emerging markets is your highest, U.S. market next, and European markets and developed markets you want underweight. Also, the dollar strengthening, that's another argument to avoid developed markets. See how I made it consistent? Weak economies and weak currencies, you definitely want to move toward the US dollar. You do not have to talk about currencies on emerging countries. As we talked about earlier in the class, a lot of emerging countries peg their currencies to the US dollar. And so they tend, it's a little, I mean, there's so much here. Usually when the US dollar strengthens, it can actually harm emerging countries because it makes their exports less competitive because they're pegged to dollar. You don't have to get into that. I'm keeping it simple. So ignore the US dollar or currencies issues when it comes to emerging markets, but do bring it into your answer on developed markets. We should expect volatile periods, and so we need some diversification. Now, this some volatile periods, she did not specifically say that was related to interest rates. This particular question, I did not have mortgage-backed securities on it. Some students see the word volatile and they automatically think, oh, volatile, avoid mortgage-backed securities. But remember, mortgage-backed securities are related to the volatility of interest rates, not to just general volatility. Could you assume that if your boss says things are going to be volatile, that that would include interest rates? That's fine if you want to say that, but make sure you clearly say that. My boss says things will get more volatile, therefore I assume she included interest rates being more volatile. In that case, I want to avoid mortgage-backed securities. This particular exam, I did not have mortgage-backed securities as one of the options to select from. But she did say she wanted more diversification. Remember, that's when your alternatives come in. Things like real estate and commodities and timber. And then the corporate law, she talks about the law change. Now, this was before the 2007 law change, but she says she expects our marginal tax rate to be 30%. The effective rate's 20%. Ignore that. Effective rate's just there as a distraction. All decisions about investing are marginal decisions. You want the marginal tax rate, which is the tax you'll pay on the next dollar you earn. And that's the decision we'll make. So you can see here we prefer U.S. and emerging markets over developed markets. So let's look at the answer. You can see the sub-bullets is what your answer needs to be. The big bullets are what I give you, except for they're not color-coded. I put the color coding in there. On the exam, you don't get the color coding, you just get the list. So I give you Treasuries, and they're long-term Treasuries. I give you Municipals. I give you Corporates. I do not, this is real important, I do not give you stocks overall. You have to remember to put that into your answer. I give you U.S. large cap, U.S. small cap, developed market, emerging alternatives. Here you can see there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. This exam only had 15 things in it, but remember, she said inflation would not be an issue, so if I had put tips on the list, you would have said underweight tips because inflation is not an issue. Remember, she didn't say anything about volatility of interest rates, but if she had said interest rates would be more volatile and municipals were on the list, you could have done municipals and say underweight them because interest rates would be more volatile. So that would get you up to 17. There's only one thing under alternatives, so normally I have 2 under there. So that's what gets you up to the 18. So this one is 3 short from normal. But remember what we have here. You go back to this, really important. We have a strong economy, so we don't need high quality. That eliminates treasuries. Interest rates are going to rise. U.S. and emerging and U.S. dollar are going to do well. So U.S. and emerging, yes. On the stock side, developed markets, no. So we start with long treasuries. Notice I have 2 answers here. Rates are rising, strong economy, shortened duration. We don't need high quality because of the strong economies. So I should have done this better. Rates are rising. We don't need long duration. We don't want long treasuries. We don't strong economies, so we don't need high quality. I should have worded that better, but anyway, that's the way it is. on the way I worded it here. You would have gotten full credit if you worded it like that, but I encourage you to be even more explicit. Have a bullet that only talks about rising rates. Have a bullet that only talks about the strong economy. All right, on municipals versus corporates. So you notice on corporates I only have one bullet, and that is, so I have the three things here. So the effective yield before tax, I want to overweight municipals. Why? Because the tax-adjusted yield, they're yielding 2.6%. You take 2.6% and divide by 1 by the marginal tax rate, and that gives you 3.71. Corporates are paying 2.9. Notice that the corporates and the municipals are both medium quality and they're both short term. So from that standpoint, municipals look a lot better than corporates. We took the tax equivalent yield. Don't take the 2.9 and divide by 1 minus 0.3. You only tax adjust the municipals. When you do that, you get 371. You compare that to the 2.9. So we prefer municipals over corporates. And then we talk about the quality. Medium quality, that's good because we're expecting a strong economy. So medium quality will give us some extra spread. The short term is good. Why? Because interest rates are rising. So you don't necessarily have to talk specifically about corporates. So I might have counted this as a bullet of the 15, but there's really only 3 here. Do you expect, what do you think about the medium quality? What do you think about the short term? And then which do you prefer between municipals and corporates? Those are the 3 bullets. I added stocks overall. Again, that won't be given to you on the list. So I prefer stocks. You're underweight bonds, overweight stocks because of strong economic growth. U.S. large cap, low beta within stocks. So remember, I did not do this very well here, but within stocks, have that in your answer. Within stocks, I would want to underweight large cap because with a strong economy, we don't need to be that defensive. Within stocks, I would underweight low beta because with a strong economy, we prefer not to be so defensive. So notice there's 2 bullets there. With small cap, we're going to overweight that within stocks. Small caps do well in strong economies. Remember, your boss is expecting a strong economy. And high beta, we like that. We like high beta in a strong economy. So there's 4 things there. I might do something like large cap, low beta, and small cap value stocks. So you have to know both style, capitalization, and beta. You have to know all 3 things. And remember, high beta for strong economies, small cap for strong economies, value for strong economies. Then developed market, remember we talked about Europe will be weak, so we want the underweight. That's why I have it in red, underweight developed markets. We want underweight developed markets because the dollar will be strong. So here I kept it consistent. On the exam, I do keep it consistent. I won't give you one where Europe will be weak, but the euro will be strong. I won't give you that. I'll make it consistent. Emerging markets, real simple. Strong economic and economies in those markets. Therefore, you want to overweight. Alternatives, she's still worried a little bit, so she wants an extra diversification. So this is a simplified question. You're starting to see now how it works, and we'll practice this more and more and more. We'll have one entire Zoom session where I'll work with you in small groups to make sure everyone's getting this really, really, really well. All right, so we're about halfway through the class, so if you need a break, this is a lot to process. So I'll stop talking for about 5 seconds and you can get something to eat or drink or stretch. Okay, so from page 24 of the notes, here's a second example. This one's a little more extensive. So remember the things you need. So quality, duration, which is about the direction of interest rates, convexity, which is our interest rates getting more volatile or less volatile, credit qualities, so strong economy, weak economy, the marginal tax rate in municipals, is inflation an issue? Again, with stocks, it's all about strong economy, high yield, it's quality. Stocks, do you want high beta? Do you want value? Do you want large cap, small cap? All of those are related to quality. With developed markets, it's the strength of those economies and the US dollar. Emerging markets, it's just a given. And then with alternatives, again, just like with tips, you're looking at inflation. You're also looking at some diversification and then also some specific Each asset class may have their own little comment in the scenario. So let's see what we can find in here. I have highlighted some words. So I believe the looming fiscal cliff. So this is back in 2013, and what was happening back then. It's so laughable today given what's going on this year. It's amazing things that really bother Congress one year, and 2 years later, that's like so incredibly unimportant to them. So at that time, we had the cap on the federal debt, which was much smaller than it is today. How much debt a U.S. government has outstanding. And Congress had put it in place that they were not going to raise the ceiling, so they would if they could not come to an agreement, they were going to have to make across-the-board cuts. They could not make a decision. They have to cut defense, have to cut welfare. Everything would have to be cut across the board. And that was called the fiscal cliff. When you hit that deadline and you did not have an agreement, then Congress would have to vote to cut the entire budget enough to get it underneath that cap. And so a lot of people were worried that was going to be very disastrous for the economy. So you had that going on. You also had the sovereign debt crisis. That's still going on somewhat with Hungary and even Italy. So some countries in Europe are definitely struggling, and even Germany is struggling now for the first time in a long time. So based on that, she thinks that the U.S. will go into a recession. So there you already have low quality. You already know something. The long-term treasuries would be great. Why? Because you want the high quality of treasuries, and with the recession, you would expect interest rates to fall or at least not move much, and you get the higher yield going out longer term on the treasuries. So you already got that just by reading that one comment. Then you have Japan following suit and Europe continuing to be in recession. So other developed markets are going to be having trouble. Economic and corporate earnings growth will be well below historical levels. So everything's just going to be bad. However, emerging countries should see decent growth. So here, the previous one we had U.S. and emerging good, developed bad. Here we have emerging good, but U.S. and non-U.S. developed being weak. So a little bit different order, but similar to last time, except for the U.S. is weak in this one, whereas emerging continues to be not extremely strong. The word decent, but within stocks, you'll probably want to over-allocate emerging. And that's because we expect these economies to have their own consumers and start spending. We're definitely seeing growth in per capita income in those countries, so they'll start trading with each other. Inflation should be well contained, so there's no need for tips. So there we have the inflation. I expect interest rates to stay in a very tight range. All right, so that phrase by itself tells you that interest rates will be very low volatility. However, she went ahead and told you that. I think rates will be even less volatile than that expected by the bond market. So she's expecting rates not to be volatile. What do you want there? Remember, that's where you want negative convexity. That's where you want to do what we say, sell convexity. Why? Well, because mortgage-backed securities, when interest rates become less volatile, they do extremely well because you're paid an extra return because of that negative convexity. That negative convexity is not a problem as long as interest rates don't move much. The other thing we can say here is interest rates not moving much. That's another argument for why long-term treasuries will be fine. Why? Because long-term treasuries tend to have much higher yields than short-term treasuries. So if interest rates are not going to move much, you might as well lock in that higher yield of long-term treasuries. So she's telling us a lot in these paragraphs. With most of the developed markets debasing its currencies, we expect the U.S. dollar to do well. That is a pretty good forecast from this time, although in the last few weeks, from the time I'm doing this video, the U.S. dollar has sold off somewhat. Not concerned about inflation. She's said that twice here. I'm not sure diversifying in the real assets at this point makes sense. She expects them to be, so here you say on real assets like real estate and commodity and timber, she's saying those assets not only they're probably not going to help us for diversification. This is probably not a good time to diversify. We probably should just focus on moving up in quality. But also, I think these assets are probably expensive. Maybe there's other ways to seek portfolio diversification. There's only one thing left, and that's private equities. So, and then the marginal tax rate is 40%. versus an effective tax rate of 25%. Remember, the marginal is all you care about. So there's your scenario. You might write it out of what do you have? Weakness in the economy, interest rates stable, not very volatile, emerging countries doing well, developed and U.S. economies doing poorly. The U.S. dollar will do well. Inflation is not an issue. Have all those written down. And then we go in through the answer. So I give you these asset classes. Again, they will not be highlighted in color. I just give you these, and then you've got to write the sub-bullet. So let's see what we have here. We have 1, 2, 3, 4, 5. And again, I don't count this separate one on corporates as a separate one. So 5, 6, 7, 8. I don't count that as 2. 8, 9, 10, 11. Oh, that's actually 10, 11, 12, 13, 14, 15, 16. So this one has 16. I did not break up small cap, and I didn't say small cap, low beta, or high beta. I did somewhat what I showed you early in the semester with William Sharp. That for large cap, he broke it up between value and growth, but he did not break up small cap and mid cap stocks. So you have about 16 things there. You notice the way I have the bullets here isn't quite exactly how I counted, but when we do the zoom, you'll see exactly how I count it, because we'll actually grade your answer in that zoom. So long-term treasuries. Now here I have underweight. I'm underweighting them mainly because I want to buy mortgage-backed securities. But however, so I do want the quality. That's good, but I don't need the convexity. I'd rather have the negative convexity of the mortgage-backed securities. If you said overweight because of the long term with interest rates stable and because you want quality, you'd be okay as long as you word it. So I'm saying underweight because I prefer mortgage-backed, but you could say overweight and then also say overweight and mortgage-backed. You'd be fine. There's more than one way to, there's not an exact precise answer here. The key is what do you say in your rationale? So if I said here, I say I want underweight, so the quality is good. So I do want that quality, but I don't need the positive convexity, so I prefer high return of munis are high quality, and shifting to mortgage-backed securities. The long term's okay because rates are stable. Okay, so municipals, remember there's three things here. They're high quality, they're long term, and then they're tax-free. Let's start to tax-free. We take the 3.8% and divide it by 1 minus the marginal tax rate, and that gives us 6.33%. That's much higher than corporates. When I do these, I use actual rates. So this was actually the difference. Municipals looked like a great deal back then, mainly because of the fiscal cliff. Remember that fiscal cliff? People were worried that the federal government was going to have to cut back, and that was really going to harm municipal governments, and so they were paying high. So it may not have been as good as it looks here. They may have had a high yield because of risk, but that's okay. But these are high quality municipals, so that's good. We expect a recession, so the high quality is good. They're also long term, so we expect rates to be stable, so go to long term. We get the higher yield by going out longer term. That's three things. On the corporates, I do say of these three, so I prefer corporates because they're high quality. I prefer corporates because they're long term, but between corporates and municipals, I prefer municipals because they have the higher tax adjusted yield. All right, so hopefully you see those three things. Mortgage backs, I want to sell convexity, which means I want to be overweight mortgage backs. Remember, sell convexity means you want to buy bonds with negative convexity, like mortgage-backed securities. Why? Because I get the extra yield from the negative convexity of these bonds, and because she expects rates to be very low volatility. So there's another item. So we already have 1, 2, 3, 4, 5, 6 items right there on that page. Stocks overall, this is just one, but I broke it in 2 bullets. But I want to underweight stocks because I expect a recession and low earnings growth, and I want overweight high quality bonds. Here you can just say underweight stocks, overweight high quality bonds because of a recession. That counts as one thing. Now here we have large cap, low beta. Again, there are 2 things there. I should have broken this into 2 bullets. Make that real clear in your notes that this is 2 bullets. I want to overweight. Why? I need to be defensive. So I want large cap and I want lower beta, but I'm strongly recommend that you make this 2 bullets. One about them being large cap and that being good, and 1 bullet about them being small cap and that's good. Same thing with small cap. If I tell you small cap, high beta, then you want to have 2 bullets, all right? We'll get more and more practice on this, but just assume there will be 2 sub-bullets under large cap and 2 sub-bullets under small cap. And you need to talk about the large cap, and you need to talk about the low beta. So, and also remember the words within stocks. I will count off if you don't say that phrase. So within stocks, I want to overweight. Remember, I'm underweighting stocks. So it's possible my large cap, low beta, I'll actually be underweighting, but relative to other stocks, the underweight will be less. So within stocks, I have a higher kind of slant toward large cap and a higher slant toward lower beta. Small cap, if this had been mid cap, it would be the same answer. I lump those together. I would underweight because of the recession. They'll underperform large cap in a recession. Developed markets, there's always 2 things there. Underweight because we expect slower economic growth in those countries, and the US dollar is expected to do well. Emerging market within stocks, again, within stocks, I want to overweight emerging because they're going to have relatively better economic growth. And then private equity, okay, I should have done 2 bullets here, so I have an error in here. I should have talked about alternatives. Alternatives, what do you want to do? You want to underweight alternatives. Remember going back here, all the real assets are priced at a premium, so I left that out of my answer, so I would have lost a point there. So if there had been 17 things, I would have gotten 16 out of 17 here. So I should have alternatives as underweight because those assets, those real assets, are overpriced according to my boss. But I would have overweighted private equity because you get some diversification from those. All right, so there is the scenario. Let me show you how this would actually look in practice. But remember, we had 6 things on the previous page. So there's 7, there's 8, there's 8 and 9, there's 10, 11, 12, 13, 14, 15. I should have had 2 here, 14, 15. So we had 6 on the first page and 9 on the second page. So you need to get all of those together. So what I want to do now is show you how this is actually done in practice. So what I've done here is created a little bit of an example of what you would see in practice. It's a little unusual because we have long-term treasuries. No firm is just going to have long-term treasuries without intermediate and short-term. We have large cap, low beta, but it doesn't make sense just to have large cap, low beta. They would have high beta and other things. But so there's definitely some things missing, especially on the bond side. But here's our policy portfolio, and remember the word policy also can be the other word for strategic. So it can be strategic or policy. Policy is the more common term because this firm will have an investment policy, and that investment policy will dictate what their long-term strategic allocation is. But this is what we would do in normal times. But your boss didn't expect normal times. Remember, she expects a weak economy, interest rates really stable. Your emerging countries will do okay. The US dollar will be strong. Real assets are going to be in bad shape because they're overpriced. So we have those volatility of interest rates will be very tame, very low. So those are what we know. So right here, my tactical matches my policy, but let's go through this. So let's start here. We said we wanted to overweight mortgage-backed securities. Remember, we said we had a preference for mortgage-backed over treasuries. And we had a preference for the high-quality municipals over treasuries. So let's start with the municipals. Let's say instead of 15%, 10%, why don't we go 18% there? We'll cut the corporates back to 18. We like the mortgage back, so go 10 there. Remember, stocks versus bonds overall, we want it to be higher in bonds than in stocks. We'll cut treasuries back a little bit. So we'll go 48% in bonds when we normally have 40%. So here's our over underweights. We're underweighting treasuries, even though we like treasuries because they're high quality and the long term. We're underweighting them mainly because we want those high quality municipals with that incredibly high yield, and we like the mortgage-backed securities. So we're going to take a little bit out of treasuries, a little bit out of corporates, but overall we'll be overweight on on bonds. Now, right now, this portfolio doesn't make sense because we have 108% in our total portfolio. We need 100. So then we get the large cap. Remember our large cap, low beta, we like those. So within stocks, we want more there. So let's cut back. We did not want small cap. Let's cut them back to 5. We really did not like developed markets. Let's cut them back. Emerging we like, so let's maybe take them up to 8%. And so then we got large cap. So with large cap, we cut back small cap and developed 5%. Let's just cut back just a little bit on large cap. So we like large cap, but within stocks we'll have a little bit more on large cap than we normally do. So if you look at this 23 and 25 divided by 50, large cap are 50% of the stocks usually. You see how I did that? So large cap is usually 50% of stocks. But now, when we take 23 divided by 41, they're now 56%. So even though large cap is a smaller percentage in total, they're a higher percentage of stocks. So that's what we mean by within stocks. All right, so within stocks, we want to have extra, and you can even look at this with small cap. Within small cap was 20% of stocks, now it's only 12% of stocks. And the same thing with developed. Developed used to be 20%, now only 12%. And then emerging used to be 10%, and we jumped that up to 19%. All right. And then we come down here to the end. Our real assets, we want to cut back on those. And we want to increase private equity. Maybe we, so here you got to get balanced out. So I got 2% left over. Let's put 18% in municipals. And let's not cut back quite as much on large cap. And so there we have it. So that's what we're talking about with overweight and underweight. It's versus some typical asset. And you also have to think within stocks, within bonds, what do you want to do? So a good example on the within, again, large cap used to be 50% of stocks. Now they're 57%, even though they're a lower percentage. Corporates used to be 50% of our bonds. Now they're only 37% of our bonds. So we cut back on corporates quite a bit, and we really increase municipals a lot. So that's that within stocks, within bonds. Use that term whenever you need it to make it really clear. The most important is in a situation like here, where you're cutting back on stocks overall, and so your large cap is actually going to be lower, but large cap as a percentage of stocks is actually a higher allocation. So make that really, really clear. I'll save this and actually put it out there somewhere for you on Blackboard. I'll link it to this particular class so you'll know that we did this. So what I want to do now is go back and let's review this again and make sure you're very, very clear on exactly what I'm looking for, not just for the exam. Again, who cares about the exam? That won't matter in your life in 5 years. But understanding this could have a huge impact on where you are in 5 years, especially how intelligently you answer All right, so here's the template again. Remember, you're looking for 18 things in this list generally. So one of them will be stocks versus bonds. Again, I do not give you stocks versus bonds. So get that into your notes. You want to have a bullet that you're going to add that says stocks versus bonds. And under that, you either want to over-allocate the stocks because the economy is going to be strong, or you want to over-allocate to high-quality bonds. Or you can say over-allocate to bonds, especially high quality, or over-allocate to bonds with tilting toward quality, whatever you want to say, because you expect a weak economy. All right, with treasuries, there's always going to be two things on the treasuries. What is the duration? If they're long-term, then you want to be looking for interest rates falling. Otherwise, you'd want to under-allocate them. And on quality, treasuries are always high quality. So if you're expecting a recession, treasuries could be good. If you're expecting a strong economy, then you do not want treasuries. Treasuries will not do well in a strong economy. Why? because you can get higher yield in other assets and interest rates are probably rising. So if you have long-term treasury, that's bad. So make sure both those are there. Hopefully you're understanding on the exam. What I want you to do is actually type long-term treasuries in your answer and then have two sub-bullets, one on duration and one on quality. That way you won't forget to do it. So get this template set up. For tips, if I give you tips, now in the examples we've done, we've not had tips. And that one we just did, inflation was not a concern. So if I had done tips, I would have shown them underallocated, underweight. And that's all related to what we think about inflation. Right now, tips look terrible. They actually have a negative yield. So unless you're just expecting a lot of inflation, and tips look terrible right now. I don't think anyone's expecting inflation in the near term. There are people arguing high inflation over the next 5-10 years, but over the next 1 or 2 years, no, I don't know anyone that's expecting really high inflation. Mortgage-backed securities, only one thing to look for there. Do we expect rates to be volatile or not to be volatile? Remember in your answer, and get this into your notes. This is a good time to make sure your notes are reflecting everything. Make sure it's not just that you want to have mortgage-backed securities when you expect rates to be stable, but anytime you say over-allocate mortgage-backed securities, you want to do it because you think rates are going to be stable and or become more stable, and they give you that higher starting yield over treasuries. It's that higher yield. Remember we talked in class, an earlier class, that if mortgage-backs and treasuries had the exact same yield, you would just buy the treasuries. The only reason you buy the mortgage backs is they have the higher starting yield, and then if interest rates are stable, you get to keep that higher starting yield. And then the big one. This is where people lose most of their points. I don't know how to emphasize this so much. This isn't enough, but put it in your notes over and over again. Make sure you can combine municipals and corporates, and you can say the same thing on duration and quality. So what you can say is municipal bonds and corporates, I prefer them because they're long-term and rates are falling. I prefer them because they're low quality and the economy is expected to be strong or whatever, or I like them because they're high quality. And then you can say between municipals and corporates, I prefer municipals because they have a higher tax-adjusted yield, or expected corporates because they have a higher yield than the municipals' tax-adjusted yield. So that's the way I would actually do it. Talk duration and quality first because they apply to both of them equally. And then at the end talks about taxes. So make sure you have those three things. That's probably the biggest miss students have. The second biggest miss students have is related to the stocks. High yield, there you talk about quality. The example we just did not have high yield, but if high yield was in that one with a weak economy, we would have said underweight. I have a lot of students who talk about high yield related to about whether interest rates are rising or falling. I do not know any high yield investors who are worried about duration. So quality is the only thing. Strong economies over allocate to high yield. Weak economies underweight to high yield. Large cap, there will always be two under large cap. Large cap themselves are high quality, and then I'll have something else related to beta or style. So make sure you have that in your answer. Same thing with small cap and mid cap. Small cap and mid cap are lower quality than large caps, so you have the quality piece, and then there'll be something either about beta or style. Sometimes what I'll do is large cap high beta and small cap value. So I'll do beta on the large cap and style on the small cap. So you got to be aware of when do you want this. So make yourself a matrix so you know when do I want high beta. Oh, in strong economies. When do I want low beta? Oh, in weak economies. When I want growth, I prefer growth. In weak economies, I prefer value in strong economies. I know that hasn't been working. Style is probably the weakest of this entire list. Hasn't been working recently because growth has just been doing well all the time. But that's the general longer term. On developed markets, there's always two things. How are the developed markets doing, and how is the U.S. dollar doing? If the U.S. dollar is strong, you do not want to be in these markets. If the U.S. economy is the strongest, you don't want to be in these markets because of quality. So again, have two sub-bullets. Emerging markets is just emerging markets. I'll give you a very declarative statement on that. If it's a strong statement, then over-allocate the emerging and just put that in your answer. And then alternatives, we've talked here on the one we just did. Inflation was not an issue, so we could underweight. And those assets are considered overpriced. Remember in the answer I gave you in the one we just did, I accidentally left this one out of the answer. And in private equity, they're low quality because they're stocks. So if you're expecting a weak economy, private equity is usually not good, but they do provide some diversification, so that can be that can be a selling point. So I'm hoping this is starting to work together. We will practice it very, very hard in the Zoom session. What we'll do in the Zoom session is I'll give you an exam question exactly like it will be on an exam, except for obviously a different scenario. You'll answer that, and then we'll have a Zoom session where we'll actually grade your answer, and you will know how prepared you are for the exam based on how you do on that Zoom session. So hopefully we'll get some very high scores on this exam. So I'll stop it there. Go back and review your notes. Go back through this again. There's other examples in the class notes. So work through those. Don't look at the answers. Just work out your answer and look at it. You can see sometimes in my answer I'll not make it quite as explicit, but I'll show you when we do the Zoom session, I'll show you exactly the template I'm grading from. And so you'll know exactly how you can do. So practice, practice, practice. If you can be successful at this, I will promise you, any question you get in an interview related to this type of issue, and you get a lot of these in interviews, you will sound better than 99% of undergraduate students, unless you're interviewing against 10 people from our class. Then you may not have as much of an advantage. Then UTSA will look smart, and you'll just have to compete against each other. But this is where the best students are separated from the mediocre students from most employers, is understanding how to do critical thinking and get into the application. So I'll stop it there. Hopefully it's starting to sink in.